Alrighty. So in today's video, we are going to be talking about a pretty special iron condor, and this is what I call the Jade Iron Condor. Now, if you are thinking, Davis, what is this Jade Iron Condor? Is this some sort of expensive iron condor that you have to call it Jade, or is this taken right out of the Tang Dynasty or something like that? Well, if you have seen my previous video where I talked about the Jade Lizard, well, then you would know that this Jade Iron Condor has some sort of a relation to the Jade Lizard, right? Because you have the name Jade. And basically, the Jade Lizard, if you haven't seen the video, by the way, I'll put the link at the top right-hand corner of this video. But basically, that is a strategy that has no risk to the upside. So it is a short put on the put side, and then there is the bear call spread on the other side. So when you combine both together, you have what you call the Jade Lizard. And you structure it in a way where there is no risk to the upside. Now, the Jade Iron Condor is basically just the defined risk version of the Jade Lizard, right? So the Jade Lizard is actually a short put where you have just the short put down here. So I'll put the short put over here to let you know this is the short put strike. And then you have the bear call spread on this side, right? So I'll put BCS. So as you can see, the bear call spread is this side. Now, for the Jade Iron Condor, it's actually an Iron Condor structure because this is actually also a put spread. So you can see down here, all right, maybe you can't really see down here. I'll just put an arrow over here. This is where your long put is, right? So basically what it is a put spread on the left-hand side. This is where you get your put spread, right? Your bull put spread. And then on the right-hand side, you have your bear call spread. So this is basically the same structure as an iron condor. Now, the only difference you will notice is that on the right-hand side, this bear call spread over here, you notice that the spread is actually pretty small, right? It's very tight, right? It's much narrower than this put spread on the left-hand side. And the reason we want to structure it in this way is so that there is no risk to the upside, okay? So basically, the Jade Iron Condor is a way for you to put on the Iron Condor so that, you do not get hit on the upside. So the market, if you notice, this is where the current market price is, all right? This is the current market price. And if the market was to go all the way up to the moon, all right, on the right-hand side is where the prices increase. If it goes past your short strike, you actually don't really have to worry because there is no risk to the upside, right? It can go all the way to the moon and you still do not lose money on this trade because if you can see it down here, right, this risk graph down here, you can see that it is above the zero line. Now, one thing to take note is that although there is no risk to the upside, that means you do not actually lose money if the market blows past your bear call spread on the upside. You still have to bear in mind that these strikes are actually still in the money. That means you have a short call strike down here. This is the short call strike. You have the short call down here. Basically, it will now be in the money. So that is why, although there's no risk to the upside, we still do not want to hold this all the way to expiration. Now, of course, there's the argument that, if the price stays within this two short strikes, right, then you can still hold on to expiration. There are people who say that, even in an iron condor, if it doesn't breaches the short strike, they want to hold to expiration. Yep, that's fine if you want to as well. But if this goes past your short strike down here, and there's, not many days left to expiration, this is where you could get an early assignment. So if you're an early assigned on a short call, what will happen is that you will become short 100 shares per contract there, right? So this is where you want to really take note of this, right? So as much as possible, we want to close out before the expiration of this whole trade down here. By the way, one more thing I want to mention is, is Jade Iron Condor actually a real name? No, it's not, right? It's not something that people has adopted. In fact, I think I'm the only one that I've adopted this as Jade Iron Condor. And the only reason is because there is a strategy called the Jade Lizard, right? The Jade Lizard is coined by the folks at Tasty Trade. So basically, the Jade Iron Condor, right, I just took after the name Jade Lizard so that, we all know when you put on the Iron Condor, there's no risk to the upside. Otherwise, this would actually just be called a skewed Iron Condor, right? A skewed Iron Condor is basically whereby the wings are uneven, right? On one side, you maybe have 10 points wide. The other side, maybe you have 5 points wide. This is what you call a skewed Iron Condor where the wings are not even. So when I use the term Jade Iron Condor, it just means that it's an Iron Condor with no risk to the upside. So maybe in future videos, if I just say the Jade Iron Condor, then you will know, oh, okay, Davis is putting on an Iron Condor that has no risk to the upside. So for our purposes only, and hopefully if this video gets out to many people, or maybe you guys can spread the word, let's make Jade Iron Condor an actual term in the options community. All right, now, so how do you actually structure this Jade Iron Condor? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so the Jade Iron Condor, one thing you need to take note of is that the bull put spread has a wider width than the bear call spread all the time, right? On the left hand side, you notice that the width is much bigger down here, right? Let me just draw the arrow down here. So the width is much wider compared to this, where you can see this is very narrow, okay? And in terms of the delta, generally on the put side, right, we want somewhere around 15 to 25 deltas, and then on the call spread side, this is where you're going to have anywhere from 25 to 35 delta. So the thing is that you really want to go to the option chain to really play around with the strikes, because you really need to get the strikes right in order to make sure that there is no risk to the upside. Okay, if you're going to have a width that is too big, then there could be some risk to the upside. So this is where you really need to know how to change the strike. So the other thing I wanted to point out, which I forgot to point out in the first slide, right, is this thing down here. You'll notice that this Iron Condor has a win rate of 85.21%. Now, this is a pretty high win rate for an Iron Condor, because an Iron Condor, right, typically the win rate will be somewhere around 65%, right? 60, 70% if you go for the very low delta short strikes, right? But otherwise, generally, it will be around 65% or so, right? Maybe even 60%. But for this, you notice you have a very high win rate, and the only reason is because on the right hand side, anywhere that it goes past down here from where the current market price is all a profit, right? So that is why there's this very wide win rate. Now the trade-off, of course, is that you will get a lower premium compared to the normal Iron Condor. So why is this so? Well, you can see on the chart down here, or rather this P&L graph, is pretty obvious, right? Because on the left hand side, you get the premium for a very wide spread, right? Let's say, for example, this is a $10 wide spread, right? So your premium will definitely be higher. But whereas on the right hand side, this could be maybe $1 or maybe even $2 wide spread. So if this is a $2 wide spread, then you're not going to get that much credit. So most of the time, you will notice that the credit which you get on the put side is much more than the credit you get on the call side. Right, so when you combine this together, you get a premium that is most definitely lower than the normal Iron Condor which you put on, because both sides would generally be of the same width. All right. Now, how do you decide the width of the bear call spread? So this width down here, how do you know how much, or rather how wide the width should be? Right, so the way you want to structure this is based on what is the total credit that you can get. Right, so the general rule of thumb is if you want no risk to the upside, the total credit which you receive has to be more than or equal to the width of the bear call spread. All right, so here's an example. So let's say, for example, on the put side, let's say, for example, you get maybe $1 in terms of your premium. All right, so for the put spread, you get $1 premium. But on the call side, maybe let's say you get only 35 cents. Okay, so what is the total premium down here? So the total premium, if you add these two together, it becomes $1.35. That means this is the total premium which you will receive for combining these two spreads together. So based on this, how do you know what is the spread you should have? So the spread should be smaller than this premium which you receive, which means to say if this is $1.35, that means the spread down here, it needs to be $1 wide. Why? Because the loss that you make on the call side is essentially just the spread width, right? So if it's a $1 wide width, if the market blows through this call spread on the right hand side, basically you will be losing $1 for this spread, right? So per contract, it will be $100. Okay, so if you have $1.35, and then you have a dollar loss on the right hand side, the width, if the market goes past this call spread, which means to say the net, right? Let's just put down here, the net becomes a positive 35 cents, right? Which means to say if the market goes past this bear call spread, all the strikes on the right hand side, right? It goes past down here, the maximum that you can make is 35 cents, which is $35 per contract that you put on, right? So as you can see, there is no risk to the upside. Now, what happens if you put, let's say, a $2 wide spread? So let's say if you put a $2 wide spread, so now suddenly there will be risk to the upside, right? So now let's cancel this 35 cents. So $1.35, you minus off your $2 loss. So this will give you a 65 cents loss, right? So it's 65 cents loss to the upside, which is actually not too bad as well, because on the left hand side you'll be roughly taking, you know, about close to $800 to $900 risk, right? But on the right hand side you're only taking about $65 risk. So if you widen out the spread on the right hand side, you could at least get more credit, because the wider the width you get more credit, and it contributes to your overall premium, right? But then you may have to take some risk to the upside, right? So this is a trade-off. So generally, if you do not want any risk to the upside, you just want to ensure that this premium down here is much more than the spread that you create down here. All right, so that's quite a bit of a drawings down here. Let me just remove all of them to make it clearer again. Okay, so let's give another example. So let's say, for example, down here, the put spread down here, let's say you get $1.50, right? Let's say if you get $1.50 for the put spread down here, and on the right hand side, let's say you are able to get, say, 60 cents. Now, if you combine these two together, by the way, when you put on this spread, let's say you put on a $2 white spread. Let's say you put on a $2 white spread, you get a 60 cents credit on the right hand side. So this in total will give you $2.10, which means to say there's no risk to the upside. Again, $2.10 covers the width of your bear call spread. Now, let's say you want to try and push the envelope a little bit, and now you go to $3 wide. Now, with $3 wide, you notice that this premium will also increase as well, right? So maybe this will now become, let's say, $1. Let's say you get $1 when you increase to $3. So now your total premium is $2.50. So now from here, you have a decision to make, right? Because immediately from this total premium, if you minus off this width down here, you're going to get a risk of 50 cents to the upside, right? $50. So down here, you have two options that you have to make a decision, is whether you want to take on this small little risk so you get more premium overall for this whole trade, or you want to have no risk to the upside and then you want to go for the $2 wide instead. So if you go for the $2 wide, so now your premium will just drop by a bit, right? It will just drop to the previous one. Okay, so there's no right or wrong. It all comes down to what you're comfortable with. Okay, so I've already covered this, right? So here's another important thing that you want to take note of when you are creating the Jade Iron Condor, is that ideally we want the call spread premium on the right hand side down here to be at least 25 to 30% of this total premium down here. All right, this total premium over here. And the reason is because if you're going to build your Jade Iron Condor and your bear call spread on the right hand side, if it's only like 5% of the total premium, then it defeats the whole purpose of you putting on this bear call spread in the first place, right? Because if the market really goes up, if the market really goes all the way up, then this put spread is going to be making a lot of money. But then you're going to cancel off your profits, right, from here because of your bear call spread on the right hand side. And for what? For only 5% of the premium, you remove all the profits that you could have taken from the put spread. So that is why we want to have at least a 25 to 30% of this total premium. So for example, if the total premium, all right, let me just remove this. So let's say, for example, the total premium that you receive for this spread is $2. So which means to say, of this $2, the call spread side, you want it to be at about 50 cents to 60 cents, right? So this way it will then be about 25 to 30%. At the same time, because if you have more premium down here, if the market actually goes down, then you have some sort of a cushion as well, right? This put spread will not take the full hit because you got quite a bit of a premium that you receive for selling the bear call spread. So in a sense, it's hedging each other. Okay, so let us take a look at how it looks like on the chart, right? So if you would take a look on the chart, it will look something like this. So for this example, I've used it on the IWM. I use this on a $15 wide spread. So this is $15 wide, and you can see on the call side, this is $2. Now, where is the profit zone? So generally for a normal iron condor, the profit zone would actually be from this line to this line. All right, generally with this line, not including the break even. If you include the break even, you'll be somewhere around here past the short strikes for a normal iron condor. Okay, this is generally because anything that goes past your break even on both sides, the iron condor will actually start to lose money. Okay, but for the Jade Iron Condor, you actually have a wider profit zone, and if I were to color code it, you can see that the profit is basically anywhere from the short put strike down here all the way up, right? Because there's no risk to the upside. If the market continues to shoot past the roof, right, then you can still make money. And on the downside, it's basically the same as a normal iron condor, right? The normal iron condor is that if the market goes past your long put strike, you cannot lose more than that because you already kept the max risk. So when do you actually put on the Jade Iron Condor? So basically, the Jade Iron Condor and the normal iron condor, you can put on whenever you think that the market is going sideways or in a very neutral way, right? But I've got quite a number of people that, you know, have actually reached out to me, say that they have tried the Iron Condor, but then the market keeps going up, right? It get hit and tested on the call side. And one thing to understand is that this is actually very common during a bull market, right? You'll be tested on the call side. So this is all part and parcel of trading. But if you're not comfortable with the risk on the call side as the market keeps going up, if you think there's going to be a positive drift, just like, you know, what the index ETFs actually have, they have positive drift over the long term, it will keep going up. You don't want your call spread to be tested, then you want to put on the Jade Iron Condor. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.